Have you ever wondered how you can earn passive income through dividend stocks? Well, today we're going to demystify just that. Imagine a stream of income that flows into your bank account with minimal effort from your side. This is what we call passive income. Now, there are several ways to earn such income, but one of the most reliable and potentially lucrative methods is through dividend stocks. These are shares in a company that pays out a portion of its earnings to shareholders, that's you, on a regular basis. But here's the catch. Investing in dividend stocks isn't a game of chance. It requires a certain level of understanding and strategy. You need to identify the right stocks, analyze their performance, and make informed decisions. It's an art, and we're here to guide you through this journey. Stay tuned to learn a step-by-step process of investing in dividend stocks. So, what exactly are dividend stocks? Good question. Let's start by breaking it down. Dividend stocks are shares in companies that regularly distribute a portion of their earnings to shareholders. These payments, known as dividends, can provide shareholders with a steady stream of income, in addition to any potential price appreciation of the stock itself. Companies issue dividend stocks for a variety of reasons. Some businesses are well established with reliable earnings and cash flow, and they decide to share a portion of these earnings with their investors. These companies are often in mature industries where there's less need for reinvestment into growth. Therefore, they can afford to distribute dividends while still maintaining their operations and investing in future opportunities. Others may issue dividend stocks to attract investors. Dividends can be a sign of a company's financial health and stability. By issuing dividends, a company is essentially saying, we're confident in our ability to generate consistent profits, and we're committed to sharing these profits with you, our investors. Owning dividend stocks has numerous benefits. First and foremost, they provide regular income. If you own shares in a company that issues dividends, you'll receive a payment, usually every quarter. This can be particularly appealing if you're looking for a source of passive income. Additionally, dividend stocks can offer the potential for price appreciation. If the company performs well, the price of its stock may increase over time. This means that you could potentially sell your shares for more than you bought them for, realizing a capital gain. Importantly, dividends are typically less volatile than stock prices, providing a more stable return. While the price of a stock can fluctuate dramatically based on market conditions, dividends tend to be more predictable, offering investors a degree of certainty in an uncertain market. Finally, dividends can be reinvested to buy more shares of the stock, leading to compound growth over time. This is known as a dividend reinvestment plan, or DRIP, and it can be a powerful way to grow your investment over the long term. Now that we know what dividend stocks are, let's understand how to find them. The stock market is vast, and finding dividend stocks can seem like looking for a needle in a haystack. But don't worry, this is not an impossible task. Let's discuss how you can identify potential dividend stocks for your portfolio. You first need to look at the company's financial health. It's essential to choose companies that are financially stable and have a history of profitability. These companies are more likely to pay out dividends consistently. You can check a company's financial health by looking at its balance sheet, income statement, and cash flow statement. You're looking for companies with low debt, steady revenue growth, and strong cash flow. Next, consider the dividend yield. This is the annual dividend payment divided by the stock's current price. A higher yield can mean a better return on your investment, but be careful. A very high yield can sometimes be a red flag that the company is in trouble. As a rule of thumb, look for companies with a yield that is higher than the average of the S&P 500, but not excessively so. Another key factor to consider is the company's dividend payout history. You want to invest in companies that have a history of not just paying dividends but growing them over time. This shows that the company is not only profitable but also committed to returning profits to shareholders. You can find this information on the company's investor relations website or financial news websites. Lastly, consider the sector the company operates in. Some sectors are known for high dividend payouts, such as utilities and real estate investment trusts. These sectors can provide a good starting point for your search. Remember, identifying potential dividend stocks is just the first step. You have to scrutinize each potential investment to ensure it aligns with your investment goals and risk tolerance. After identifying potential stocks, the next step is to analyze them. This involves taking a deep dive into the company's financials and understanding the business model, but that's a topic for another scene. Stay tuned. Remember, not all dividend stocks are created equal. Just like a master chef scrutinizes each ingredient before it makes its way into the pot, a successful investor scrutinizes each stock before it lands in their portfolio. When analyzing dividend stocks, there are a few key metrics to consider. Firstly, we have the payout ratio. This is the proportion of earnings a company pays to its shareholders in the form of dividends. A lower payout ratio could indicate that the company is retaining more earnings for growth, while a higher ratio may suggest that the company is generating enough profit to comfortably reward its shareholders. However, a payout ratio that's too high could signal financial instability, so it's a delicate balance. Next, take a look at the dividend growth rate. A company that consistently increases its dividends over time is a promising sign. It shows that the company is not only profitable but is also committed to sharing its success with its shareholders. A slow and steady growth rate can be more sustainable and reliable than sudden spikes and drops. Lastly, don't overlook the company's earnings. Strong and consistent earnings indicate a healthy business, which is crucial for maintaining and growing dividends. Remember, dividends come from profits, so no profits, no dividends. But don't put all your eggs in one basket. Diversification is key when it comes to investing in dividend stocks. Spreading your investments across different sectors can help mitigate risks. That way, if one sector takes a hit, your entire portfolio won't go down with it. Think of it like a well-balanced meal. You wouldn't just eat potatoes for dinner, right? You'd want a bit of protein, some veggies, a nice dessert. Similarly, a well-rounded portfolio might include a mix of high-yield stocks, stable blue-chip companies, and perhaps a dash of growth-oriented stocks for good measure. Once you've analyzed and selected your stocks, it's time to start investing. The world of dividend stocks may seem complex, but with a little bit of knowledge and a dash of patience, it could serve up a steady stream of passive income, and who wouldn't want that? So, how do you actually go about investing in these dividend stocks? It's simpler than you might think. Let's walk through the process together. First, you'll need to set up a brokerage account. This is an account you open with a brokerage firm that allows you to buy and sell stocks. There are many types of brokerage firms out there, from traditional ones like Charles Schwab and Fidelity, to online platforms like Robinhood and E*Trade. It's crucial to select a brokerage that aligns with your investment goals, offers low fees, and provides excellent customer service. Once your account is set up, the next step is doing your homework. You've already learned how to identify and analyze dividend stocks. Now it's time to select the ones you want to invest in. Remember, diversification is key. Instead of putting all your eggs in one basket, aim to invest in a variety of dividend stocks across different sectors. This reduces your risk and increases your potential for steady income. After choosing your stocks, it's time to place a trade. This is as simple as logging into your brokerage account, finding the stock you want to buy, and clicking the buy button. You'll need to specify how many shares you want to purchase and at what price you're willing to buy. Then, you'll confirm the trade, and voila, you're officially a stock owner. But the journey doesn't end there. One of the most important aspects of dividend investing is reinvesting your dividends. When a company pays you a dividend, you have the option to take the cash or reinvest it back into the company by buying more shares. By choosing to reinvest, you're putting your money to work, allowing it to grow exponentially over time. This is the magic of compound interest. So, as you embark on your dividend investing journey, remember these key steps. Set up a brokerage account, do your homework, diversify your investments, place your trades, and reinvest your dividends. And there you have it. You're now a dividend stock investor. Let's quickly recap what we've covered today. We kicked off by introducing the concept of passive income through dividend stocks. We then delved into understanding what dividend stocks are. Essentially, these are shares in companies that pay out a portion of their profits to shareholders on a regular basis. We moved on to identifying potential dividend stocks for investment, focusing on those with consistent dividend payouts and strong financial health. After that, we explored how to analyze these stocks, looking at factors like dividend yield and payout ratio. In the last scene, we discussed the actual process of investing in dividend stocks, emphasizing that this is a long-term strategy for generating passive income. It's not about quick wins, but steady growth over time. Remember, investing is a marathon, not a sprint. If you found this video helpful, don't forget to like, subscribe, and share with others who might be interested in earning passive income through dividend stocks. Thanks for watching. The information provided in this video or communication is for informational and educational purposes only. It is not intended as and should not be considered financial, investment, legal, or tax advice. The content is based on general principles and may not be applicable to your specific financial situation or needs. Always consult with a qualified financial advisor, accountant, attorney, or other professional before making any financial decisions or taking any actions related to your finances. Any investments or financial decisions you make are solely your responsibility. Past performance is not indicative of future results, and there are no guarantees of any specific outcomes or returns. While every effort has been made to ensure the accuracy and completeness of the information provided, we do not warrant or guarantee its accuracy, reliability, or suitability for your individual circumstances. We do not endorse or promote any specific investment products, services, or strategies mentioned in this video or communication. Any references to such products, services, or strategies are for illustrative purposes only and do not constitute a recommendation or endorsement. You should conduct your own research and due diligence before making any financial decisions. In summary, this video or communication is not financial advice, and you should not rely on it as such. It is essential to seek professional advice tailored to your specific financial situation and goals before making any financial decisions or taking any actions.